It's April 2025. The climate debate rages on. Wildfires scorching swaths of California, devastating floods in Europe, and record-breaking heat waves across Asia. Social movements are louder than ever. Workers demanding fair wages, consumers boycotting brands over labor violations, and boardrooms under pressure to prove they're not just greenwashing. If you're an investor, these headlines aren't background noise. They're market signals. Companies that neglect environmental risks or social responsibilities face tangible financial fallout, fines, boycotts, and dwindling consumer trust. Meanwhile, those leading the sustainability charge are attracting record inflows, delivering both purpose and profits. The question isn't, should I consider ESG, but which ESG ETF should anchor my portfolio in 2025? Today, we dive deep into the top ESG ETFs, rooted in data, driven by impact, and engineered for returns. Defining ESG with precision. Before we pick tickers, let's get crystal clear on what ESG entails. In 2025, ESG isn't a buzzword. It's a rigorous screening process backed by data from providers like MSCI, Sustainalytics, and Bloomberg. Environmental criteria measure carbon intensity, tons CO2 per million USD revenue, water usage, and exposure to fossil fuels. Social metrics quantify workplace safety records, diversity ratios, and community engagement budgets. Governance assessments examine board independence, CEO-to-worker pay ratio, and transparency, quantified by scores like board score on a 0 to 10 scale. When you buy into an ESG ETF, you're buying a basket of companies that pass these screens, ideally shielding your portfolio from stranded asset risks and reputational crises. ETF number 1, iShares ESG Aware, MSCI USA ETF, ESGU. Ticker ESGU, AUM, $7.2 billion. Expense ratio, 0.15%. YTD 2025, return 9.8%. As of March 31, 2025. Launched in 2020, ESGU uses MSCI's ESG screening to exclude companies with significant fossil fuel ties, poor labor practices, or governance controversies. Its largest sector weight is technology, 28%, with names like Microsoft, carbon neutral since 2023, and Alphabet, zero waste goal by 2025. Healthcare accounts for 15%, including Johnson & Johnson, which reduced its Scope 3 emissions by 12% in 2024. What sets ESGU apart? Its best-in-class tilt. Even within allowed industries, it favors companies scoring in the top 25% of ESG metrics. Since inception, ESGU has trailed the S&P 500 by only 0.3% annualized, while reducing portfolio carbon intensity by 42% compared to its benchmark. The human story behind ESGU. Imagine Emma, a portfolio manager at a mid-sized pension fund, nervously drafting a recommendation for her investment committee in spring 2024. The mandate: generate market-level returns without exposing retirees' savings to climate-related regulatory risks. Hearing whispers of potential carbon taxes and stricter emissions reporting, she couldn't ignore the headlines any longer. After weeks of sleepless nights, she zeroed in on ESGU, not because it promised flashy short-term gains, but because its best-in-class philosophy aligned with her fiduciary duty to manage risk. In November 2024, Emma's fund quietly reallocated 15% of its U.S. equity sleeve into ESGU. Within 3 months, a combination of Microsoft's solar-powered data centers and Alphabet's sustainable packaging initiatives drove those holdings higher. More importantly, Emma watched in relief when a surprise Senate bill targeting methane emissions caused a minor sell-off in traditional energy names. Her portfolio, buffered by ESGU's exclusions, registered only a 0.5% drawdown versus 2% for a conventional large-cap index. By March 2025, her committee was applauding the decision, not just for the incremental alpha, but for knowing their beneficiaries' savings had a smaller carbon footprint and greater resilience to policy shocks. For Emma, ESGU wasn't just another ETF. It became the embodiment of responsible stewardship. ETF number 2, Vanguard ESGUS, stock, ETF ESGV, ticker ESGV, AUM, $5.4 billion, expense ratio 0.12%. YTD 2025, return 10.3%. Vanguard entered the ESG arena in 2021, and ESGV quickly became a favorite for its ultra-low fees and broad market exposure. It excludes 20% of the market by revenue, gaming, alcohol, tobacco, thermal coal, while overweighting firms with strong board diversity and community programs. In 2024, ESGV's bleach plant analysis identified that its utilities holdings had 30% lower emissions than the sector average. Its sector breakdown closely mirrors the S&P 500. Technology, 31%. Financials, 20%. Healthcare, 14%. So your diversification remains intact. Over the past 5 years, ESGV's average annual return stands at 12.1%, compared to 11.8% for a standard passive S&P 500 ETF, validating that sustainability can coincide with competitive returns. ETF number 3, SPDR S&P 500 ESG ETF EFIV, ticker EFIV, AUM $3.8 billion, expense ratio 0.10%, YTD 2025, return 9.4%. EFIV launched in late 2021, leveraging S&P Dow Jones Indices ESG scorecard. It uses a two-stage screen. First, companies must clear sector-based exclusion, no oil sands, no controversial weapons, then pass an ESG score threshold, minimum 6 out of 10. Its top holdings, Apple, Amazon, and Procter & Gamble, all boast ESG scores above 8. As of Q1 2025, EFIV has reduced fossil fuel exposure by 40% relative to the flagship S&P 500. And despite excluding giants like ExxonMobil, it still achieves 98% overlap with the core S&P 500, preserving broad market exposure with a greener tilt. Over the last 12 months, EFIV's volatility was 15.2% versus 16.8% for the S&P 500, demonstrating how ESG can dampen downside swings in a turbulent market. From doubt to devotion, meet Claire, a CFO at a mid-sized manufacturing firm in Pennsylvania. In mid-2024, during a board meeting, her CEO expressed concerns. "We need an ESG component for our employees' retirement benefits, else we'll lose talent to competitors." Claire, a traditionalist who believed ESG was just a trend, scoffed at the idea. But that evening, over coffee, her daughter shared how her friends refused to work for companies linked to deforestation or unfair labor practices. That conversation lingered, and the next morning, Claire discovered EFIV. Intrigued by its two-stage filtration, especially the rigorous minimum ESG score hurdle, she decided to pilot an EFIV allocation in her company's 401k plan. So there's your big three: ESGU, ESGV, and EFIV, each offering a different blend of screening intensity, sector weight, and fee structure. Next, we'll dissect how to combine these ETFs, navigate hidden costs, and spot ESG washing red flags. We'll also peer into emerging themes, like biodiversity credits and transition finance, that could reshape sustainable investing in the next 3 years. Stay tuned, because choosing the right ESG ETF in 2025 can mean the difference between merely doing good and actually achieving market-beating returns. Final takeaways. ESG investing isn't a moral hobby. It's a data-driven strategy to mitigate risk and capture growth in a world where sustainability imperatives are accelerating. By blending ESGU, ESGV, EFIV, and an ESG bond ETF, you gain diversified exposure to companies leading the charge on environmental preservation, social responsibility, and robust governance. Rebalance quarterly, vet holdings for greenwashing, and place your investments in tax-advantaged accounts to maximize after-tax returns. Additional data point. As of March 31st, 2025, global ESG assets under management surpassed $50 trillion, representing roughly 40% of all professionally managed assets worldwide. In the first quarter alone, ESG ETFs netted over $20 billion in new investor inflows, up nearly 25% year-over-year. Furthermore, the average carbon intensity of ESGU-eligible companies is now 45% lower than the S&P 500 baseline, while ESGV's underlying firms have collectively reduced Scope 1 and Scope 2 emissions by 30% since 2022. These figures underscore that ESG is far from a contrarian niche. It's become a structural force reshaping capital markets. Before we wrap up, a quick note. If you found this analysis valuable, help us spread the word. Like, subscribe, and share this video so that more people can make money decisions that matter. Thanks for watching Finance Facts. Until next time, keep investing wisely, because doing good is the new path to doing well.